Hello, my name is Craig Stanley. I'm the CEO of CBO Financial. Welcome to our brief overview of the New Markets Tax Credit Program. Our team has been involved in the program from the very beginning. We were first round allocatees, as we're known, back in 2004, and there were only 66 groups at that time that received an allocation. We also received a second round allocation when only 62 groups got an allocation, and only about 10 of those were both first and second round allocations. So at that time, we had 8 pages of temporary regulations, and we're introducing the program to bankers and other potential participants in the program, including, of course, developers and project sponsors, and have felt like ambassadors for the program since its inception. So welcome to our overview. I would like to start out with a very brief overview of our company. We're now a 10-time New Markets Tax Credit allocatee, having received 6 federal allocations and 4 state allocations, totaling about $170 million. And we've also taken a leadership role in authoring 11 applications for clients that resulted in $390 million in allocation over the years. We've been responsible for taking a leadership role in about $1 billion worth of transactions in low-income communities. Now, I would like to move on to our overview of the New Markets Tax Credit Program. The New Markets Tax Credit Program was established in December of 2000 at the end of President Clinton's administration, and its primary mission is to incentivize investment in low-income communities that would not otherwise occur. And by the not otherwise occur, we mean that the projects have maximized financing from outside sources, but still have a gap relative to project costs and need non-conventional financing in order to close that gap. The New Markets Tax Credit Program provides very, very flexible financing for these projects that are located in low-income communities, and the tax credit can result in flexible financing for about 20 or 25% of the overall project costs. The program is administered through independent companies known as community development entities. And these entities become certified as CDEs, and then they compete annually for authority under the program. Once this authority is awarded, the CDEs go out and seek opportunities to make investments in low-income communities that will help to revitalize them. And they have thresholds that they must meet for deployment in order to apply again. So after awards are made, and there is $5 billion annually that is being awarded every year through 2025. The CDEs are somewhat scrambling to find projects, but they always are interested in knowing about interesting projects that may meet their mission. There are 2 ways to access New Markets tax credits. The first, for individual projects, is for project sponsors to appeal to individual CDEs for a suballocation of tax credits that will close the financing gap that they are experiencing in their financing. It will be important to show that the project has a legitimate, what we call but for, so that the project cannot proceed but for the subsidy provided by the New Markets tax credits. For groups that have a pipeline of projects like banks or finance companies, it may make sense to form a CDE and apply for a direct allocation to the U.S. Treasury Department. In order to be certified as a CDE must be a corporation or partnership, so sole proprietorship is not an eligible entity to become a CDE. They must be for-profit entities. However, nonprofits can form for-profit subsidiaries when the time comes to actually deploy the credits. The reason it has to be for-profit is because the credits are returned for an equity investment into a CDE. We'll get to more of that later in this presentation. And most importantly, the CDEs must meet 2 primary criteria. The first is that they have a primary mission of serving or providing investment capital for low-income communities or low-income persons, and that they are accountable to residents of the low-income communities that they serve. The first requirement is fairly easy to meet. Most entities are startups that are applying for CDE certification, and there is a clause put into the Articles of Incorporation that specifically says typically that this entity is being established to serve low-income communities, and that's it. So that's one way to meet that requirement. More difficult is the accountability requirement, and by accountable, what this means is that the U.S. Treasury Department wants to see some oversight by people that are on the ground in the low-income communities and to provide some local insight into how the tax credits are deployed. And the typical way to meet this requirement is to have at least 20% of an advisory board that is populated by individuals that meet these requirements. And the CDE service area is established by the service area of its advisory board that is meeting this accountability requirement. For example, about 50% of the awards every year are made to national CDEs. The way that these national CDEs get the national service area is by employing or populating their advisory board with individuals that have a national scope. For example, people that are involved in national nonprofits that serve low-income communities, either in community health or potentially charter schools or other aspects of community development. That's a primary way. There are a lot of CDEs that are set up for a very local geographic area. For example, a single county in a state may then want to populate its advisory board with individuals that are involved on a county level in providing Head Start centers, for example, for free child care for low-income populations. And even a minister or pastor can qualify if their congregation is mostly low-income. Elected officials can qualify if their constituents are primarily from low-income census tracts as well. So it's important to look at the accountability requirements and establish an advisory board that meets these requirements. You can also meet the requirement by having at least 20% of your governing board be accountable to the low-income communities. So once certified, the CDE is then eligible to apply for a direct allocation of New Markets tax credits. The average award is around 45 to 50 million. And as mentioned, the CDEs then go to find projects to allocate these credits to located in low-income communities. And they're looking for very high impact projects, which we'll talk about more in the next coming slides. Here's a graphic depiction of how the New Markets Tax Credit Program works. In the middle is a Community Development Entity, or the CDE, that once it becomes certified is eligible to apply to the federal government for a direct allocation of tax credits. Once an award is received by the CDE, it therefore identifies borrowers that have a gap in financing with high impact projects in low-income communities that could utilize the benefit of the subsidy provided by the New Markets tax credits. Terms are agreed to between the CDE and the borrower, and at that point the CDE goes out to identify an investor in the tax credits. That investor essentially pays the net present value for a stream of tax credits over a 7-year period that we'll talk about a little bit later in this presentation. But suffice to say that the investor puts money in that is able to be very flexibly invested because the investor receives all of its return in the form of the tax credits. So there is no return of principal, meaning that the CDE can be very, very flexible in the terms, in terms of debt service coverage ratio and loan to value. And at the end of the 7-year compliance period, the loan is typically forgiven so that the borrower has a true cash equity when all is said and done. In order to be eligible for New Markets tax credit, a project must be located in a low-income census tract, and that is defined essentially on 2 different thresholds. The original definition when the program was enacted in the year 2000 was that the credits could be deployed to census tracts with a 20% poverty rate or median family income that is at or below 80% of the area median family income. So the first 2 or 3 years of the program, those were the requirements, and then Congress wanted to direct the subsidies into more severely distressed census tracts. So a new threshold was introduced at that time, and that is a target of 30% poverty instead of 20% poverty, or less than 60% median family income instead of the 80%. So it is driving that investment into more severely distressed communities. And there is a question on the application as to what percentage of your award, should it be awarded, would be committed to severely distressed communities. And since this new rule came in more than 15 years ago, I would say 100% of the awards have been made to groups that check the box that said 75% or more. So de facto, about 75% of the new markets tax credits that are awarded every year are reserved for these severely distressed communities. And it's very important to note that there is a provision known as targeted populations that allows a project to be deemed eligible if it serves a majority low-income population or has a majority low-income staff. So that's called targeted populations, and is really designed to allow projects like a community health center in a relatively wealthy community to still be able to be built and serve that community's low-income population. Almost all business activities are eligible for new markets tax credits except for the rental of residential units and a short list of sin businesses that we do not want to encourage in low-income communities. With regards to the rental of residential units, the new markets cannot be combined with low-income housing tax credits, and the rule for new markets is that it can finance mixed-use projects as long as the revenue from the rental of residential units is not more than 80% of the revenue for the overall project. So you can have commercial and residential rental combined as long as it is well below that threshold. And with respect to the sin businesses, there are specifically identified businesses, including golf courses, racetracks, gambling facilities, certain farming businesses that have assets over $500,000, and liquor stores, tanning salons, massage parlors, and things that, as I mentioned, we do not want to incentivize in low-income communities. Aside from being prevented from being twinned with the low-income housing tax credit, the new markets tax credit otherwise can be combined with a wide variety of other local and federal programs, including state-level new markets programs that we'll discuss in a moment, EB-5 financing, renewable energy tax credits, historic credits, film tax credits, CDBG money, USDA guarantees and grants, hazard mitigation grant programs, PACE, as mentioned, a wide variety. So if there are other sources of financing that can meet the requirements of the new market program, then they can be included in the capital stack, and credits can be leveraged on them to the extent that every dollar that goes into the new market structure will come out as $1.25. Therefore, we endeavor to put all sources of capital into the new market structure. Sources and uses for a typical new markets tax credit transaction. In this case, we have a project budget of $10 million. If you look at the uses line items for building acquisition and renovation, debt service reserve, working capital is all included, equipment and supplies, all of that can be included in the project budget and have new markets tax credits assist in its financing. So with that $10 million budget, if we go up to the sources line items, we first have a combination of senior debt, and that would be coming from other conventional lenders, potentially municipal funds or federal funds with or without guarantees, owner equity, and any other funds in terms of contributions or funding that the project sponsor has been able to obtain. However, after their best efforts at raising all of the funds necessary for the project, they were unable to do so. And this is often due to some of the challenges of working in low-income communities. For example, surrounding real estate prices may be depressed because very often there's a lot of vacant property, meaning that even though you're making improvements to your property, it may not resell for much based on the resale value of surrounding property in the neighborhood. Another is that the expenses associated with renovating an historic building or a previously vacant building may be higher than would be traditionally experienced, and therefore the project can't afford to borrow the traditional amount of money from a debt service coverage perspective. And very often projects that serve low-income communities rely on government funding, which has been cut over the years, and they simply don't have the reimbursement rates that would allow them to borrow enough money in order to build a facility to have, for example, a community health center that provides free medical care to low-income patients. So in this case, new markets tax credits were applied to the transaction. The investor on the second line item of the sources there, the NMTC equity, paid $3.662 million for the tax credit stream that will occur over the 7-year compliance period. And coming back down to uses, if you look at the additional uses, the legal and accounting is quite high on new market tax credit transactions. They are very complex to fund, and there's a lot of legal and accounting work necessary that is very unique to other transactions. But that money comes out of the $3.6 million that the investor has paid up above. And then new markets tax credit fees for the CDE and placement fees can vary. Different CDEs have different fee structures. There's a quasi-industry standard, if you will, that pays the CDE 5% of the amount of tax credits that it is providing. So in this case, it would be 5% of that $11.44 million. And then it receives a compliance fee or asset management fee over the 7-year compliance period, which is usually 50 basis points per year or less on an annual basis. So that equates to another 3.5 basis point or 3.5% or so, that 50 basis points for 7 years. So the CDE fee load is typically around 8.5%. Then on top of that, you may have hired consultants or other professionals to assist you with preparing your project for the new markets tax credit industry and for guiding the project through closing. So that can add another 1.5% in this case. So in this case, there is a fairly significant fee level, but in the end, if you look at the net benefit of the new markets, we had $3.6 million come in from the investor. Even if you take out all of the legal and accounting at $300,000, even though any $11 million or $10 million transaction is going to have some expense for legal and accounting, but even if we take all of that out and take out all of the CDE and placement fees, the project is still left with $2.2 million in net subsidy, and that is typically returned or forgiven to the borrower at the end of the 7-year compliance period. And that represents 22% of that $10 million project budget. So it's very significant and is real cash that comes into the project at the beginning when the construction loan and everything else funds. So it's a very powerful incentive to develop projects in low-income communities. It's important to note that several states have enacted new markets tax credit programs to piggyback on the federal program in order to magnify the impact in their states of this program. And they can provide up to a doubling of the impact in some cases. Some states have 25% of additional subsidy for the new markets tax credit, meaning you can get 20 to 25% from the federal and 20 to 25% in cash subsidy from the state program, meaning your project could be starting off with about 50% cash subsidy in terms of its financing. For individual projects seeking to appeal to CDEs for a portion of their allocation in order to close financing gaps, it's important to know what CDEs are looking for in a project. First and foremost, the project must be consistent with the CDE's mission. Every CDE has a unique mission that in some cases is focused on healthcare or education or manufacturing or renewable energy or a combination of all of those. And also that the project is within its geographic service area. And that is dictated for each CDE by its accountable members on its advisory or governing board. And then, as mentioned earlier, projects located in a severely distressed census tract have a better chance of receiving credits, as about 75% of the credits are reserved for these more severely distressed areas that have a 30% poverty rate instead of the minimum 20%, or 60% or less of median family income instead of the minimum 80%. Then it's also very important to have your other debt and other sources of capital in place. This program is really meant to come in last and close that last 20 to 25% of the project costs that cannot be closed by conventional sources. And that but-for is very important. It won't be a surprise to find out that the competition among projects for these credits is extremely high. And the CDEs are under time pressure to deploy their credits so that they can apply for more in ensuing rounds. So you cannot have a serious discussion with a CDE until you are really ready to go and you have your permits. The perfect project is one where a building permit is ready to be pulled and you have commitments for all of the other financing that is required except for 20% that can be closed by the new markets tax credits. And the credits can then come in and close that gap function as originally designed and allow the project to proceed with not only an investment occurring in the low-income community, but the ensuing goods and services that occur because of the project. And in addition to the debt investors, you want to have your New Markets Tax Credit equity investor in place with an executed term sheet as part of the request package for the CDE. As mentioned, it should be building permit ready, and most important of all, have very substantial community impacts, either in the number of disadvantaged people served, for example, in a community health center or in an inner city charter school, or jobs created, or blight removed. There's a wide variety of impacts, both in, or I should say all three, environmental, social, and economic, that need to be identified and highlighted for the CDEs. We as CDEs are looking for projects that will be cornerstones for revitalization of communities, to the point where it's an initial investment that causes other investment to occur. For example, once a high quality charter school goes in, very often people will renovate dilapidated housing to move in and to be near the low income or the charter school, and then businesses will move in after that to help serve the growing community. So that's the kind of impact that we're looking for. And also, very importantly, projects that cannot move forward without the New Markets subsidy. This program is not just meant to reduce the amount of debt that a developer needs to borrow or the amount of equity a developer or project sponsor needs to put in, but it really is meant to help projects move forward that cannot otherwise proceed without the subsidy. Thank you for listening. The CBO team is ready, willing, and able to help with your project. We would love to learn more about it. You can shoot an email to the address below or visit our website and fill out the intake form on our website. Our website also has a lot more information about the New Markets program and FAQs and project examples that we have funded in the past. So we hope to hear from you in the future.